Hello, I'm Ross Mould, AJ Bell's Investment Director, and I'm here to discuss the subject of exchange-traded products, ETPs, and how investors can use them to build a portfolio that suits their personal financial goals, time horizon, and appetite for risk. Now with me is Pav Sharma of ETF Securities, one of Europe's leading providers of exchange-traded products, and we're going to look at how we can use ETPs to track, target, a variety of major financial markets. So Pav, thank you for your time.
Thank you.
So what sort of asset classes or benchmark indices can investors track or follow with an ETP?
So the great thing about exchange-traded products or ETPs is that they offer sort of exposure to a vast array of different asset classes and exposure types. That's all the way from traditional asset classes like equities, fixed income, all the way through to commodities, currencies, property. To a large extent, we like to think they've really democratized the investment landscape. What they've done is provide investors with a great deal of choice, and we believe that's a good thing for the market.
So they're actually a way of, for some investors, accessing areas that may otherwise have been not forbidden to them, but very difficult to access in a cost-effective manner.
Exactly. A good example of that would be commodities. So prior to the invention of ETPs or ETCs, exchange-traded commodities, private investors would not have been able to really access asset classes like energy or some agricultural products, or even some of the precious metals like gold in a simple, cost-effective manner.
I mean, ETF Securities is well known for its exchange-traded commodities product in particular.
Absolutely.
Can you give us a feel for exactly how the ETP tracks the performance and generates it for the holder of the underlying asset, whether it's energy or corn or pigs or whatever it happens to be?
Yeah. So commodity ETPs are generally structured as exchange-traded commodities. So you'll often see the term ETC being used. In terms of the structure, there's two types of commodity ETC. You've got physically backed products and you have synthetic products. So I can provide a few more details.
Yeah, so physically backed means they actually own the bar of gold or the bar of silver.
Exactly.
Synthetic means they use derivatives to track an index, is that correct?
Yeah, exactly. So what we do is engage in a swap agreement. So on the physical products first, take for example, physical gold ETC is very popular with a vast array of different investors. Those products are essentially backed by a specific quantity of metal. Right. And all we do is we take the gold and we store it in a vault. So what investors get is an exposure to price movements in the spot price movements in a given commodity.
Of the metal or the physical underlying.
Exactly. So it's a very simple structure. We like to think it's an all-in-one approach. Yeah. Performance and security is delivered through the underlying asset. Now the question arises, well, why do we have synthetic products in the market? The reason is
my next question.
Yeah, exactly. Not trying to preempt you.
No, that's good.
But the sort of the key point to make here is that a number of different commodities, they can't be stored, or it's very difficult to store. So we can't go away and store crude oil in a vault.
Or it's very expensive, there's insurance, it's inconvenient, I guess, are the big issues.
Exactly. So. And so really it's a necessity. That's where synthetic commodity ETCs have really come into the fore.
And presumably the other advantage of a synthetic is there's no risk of the investor being delivered 1,000 bushels of wheat or something when they least expect it, I suppose.
Well, exactly, and it's a good point as well. So in order to maintain a continuous exposure, what the inline index does is it continuously rolls futures contracts. So it's important for investors to think about the total return of the underlying index. So what they're getting exposure to in the synthetic product is movements in futures contracts prices, but also they need to bear in mind the raw return. So that's the cost or benefit of rolling futures contracts.
We could go into contango and backwardation, but we'll probably leave that for another time.
Absolutely.
If that's okay. Thank you very much for your time, Pav. That was great. And thank you very much for watching, and we look forward to seeing you another time.